Hello everyone and welcome to another ADGM webcast. Welcome back to those of you who managed to take vacation or staycation, and welcome back to more of our webcasts. Over the ones we did in spring, we focused perhaps more on making sense of everything that was changing then and on support to business. Now more on opportunity. And first off, for the fall series, we're going to revisit the big picture, look at the global and regional macroeconomic conditions. Big questions include what's been happening, what are the key trends from COVID and others, and how have they impacted businesses and investors? Are we past the worst of the pandemic yet, and what will recovery look like? And looking forward, how do we play it for the future? Here to help, and it's really great to have you with us, is Simon Ballard, Chief Economist of First Abu Dhabi Bank. We're really excited to hear your views. I know, Simon, you have prepared some material to help us follow your analysis, and we'll start with that, followed then, as usual, by a Q&A. As always, and I'm talking to the audience now, we really look forward to hearing your questions. Please post them on the media channels you're watching us by, and our team will make sure it gets to Simon in the studio. Now, Simon, it's great to have you with us. As I'll hand over to you, I want to ask you for two things. We'd really love to hear some more about you and your background, and then, of course, how do you make sense of the situation? Simon, welcome.
Martin, thank you very much indeed for those kind words of introduction. Good afternoon, everybody. A pleasure to be here and a pleasure to be offering some of my current thoughts to the ADGM webcast as per Martin's introduction. Yes, my name is Simon Ballard. I'm First Abu Dhabi Bank's Chief Economist based in Abu Dhabi. Been here in the region for 3 years, but visiting family and friends in the region for nearly 25 years now. I'm very familiar, therefore, with the trends and the changes and the challenges that we've seen in this region over that period. Prior to being at First Abu Dhabi Bank, I've worked in London and New York, and so hopefully have managed to garner a degree of global investment strategy expertise, but I'll let you be the judge of that as we work through the presentation which I've put together for this morning's discussion. So if I may, I will now move across onto my presentation, flick through the slides in the course of 30 minutes or so, and then open it up to Q&A at the end of that. So thank you very much. Okay, so I hope we're now sharing my screen with my introduction slide, the evolving global macroeconomic conditions. And the question that everybody is posing is, dare we look beyond, can we look beyond COVID-19 and what it's done to the market? Some of the most important macroeconomic trends for businesses and investors are now beginning to emerge after what has been a cratering, I would suggest, of economic expectations for 2020 and indeed for 2021. We've seen a seismic move in markets. We've seen seismic challenges being presented to investors and businesses around the world as we try and ascertain the depth of demise that will come from the pandemic, and more importantly, what shape the recovery might be in the coming months. One of the key takeaways for the moment really has been that, as we see in this slide here, that the Federal Reserve, the ECB, global central banks have taken monetary policy to the loosest that feasibly they can at this stage, towards the zero bound and almost into negative territory for the ECB's deposit rate. And at the same time, of course, that has come at the cost of their balance sheets, which we've seen expanding exponentially over the course of this year in response to that pandemic and the downturn. For the time being, we believe that the front end of the yield curve remains very well anchored. That means that central banks will not be in a position to raise interest rates for the foreseeable future. And we've heard this from the Federal Reserve, from the ECB, from the Bank of England, and from other banks. that in actual fact, monetary policy tightening will be something that we only have to think about and address, perhaps in the early stages of 2022 and beyond. That said, as we start to price in optimistic expectations of economic recovery beyond the initial impact that we've seen from COVID-19, and that recovery we hope will come through in the stages of 2021, then we will see what we would term as a bear steepening of the yield curve in the United States. A bear steepening meaning a sell-off in the longer end of the curve. Here I'm looking at the 10-year Treasury yield versus the 2-year Treasury yield, and that we expect to continue to edge higher as we get that sell-off in longer dated rates, but are still well anchored lower front-end rates around that 0% level. But we're clearly not out of the woods just yet. What we have seen is very much a divorce between fundamentals and valuations. US GDP, obviously, in the second quarter, down 30 odd percent, and we've seen that in Europe as well. Meanwhile, of course, the fiscal accommodation, low monetary policy from central banks has driven risk assets higher. So we've seen this divorce between a rallying equity market and a plunging fundamental economic growth scenario. And the question is, which one is right and which one will give ground first? The recovery or a correction in asset prices? And I'll probably argue that we'll be somewhere in between the two this time next year. COVID-19 potentially reversed the record labor market tightness. And of course, one of the attributes that the US market had been singing for many moons was the strength of the labor market. We've seen obviously a demise in and an increase in unemployment rates around the world as furlough schemes, as lockdowns have taken place. More importantly now, looking at the UK, we'll discuss the unwind of the furlough scheme and the hidden rise in unemployment that will probably bring with it at the end of that support package. Our outlook for the labour market, therefore, remains optimistic, but we will still be well away from the lows that we got to at the end of 2019, the early part of 2020. This top chart here, looking at the US unemployment rate, the blue line, obviously spiked significantly. We were at 3.5% at the end of last year, a historic low for US unemployment. That spiked to almost 14% in Q2. That has come back down now sharply, but still well above the levels that we had previously. And that's important because it means that if you're out of work, you're less likely to have disposable income to spend. Why is that important for the economic outlook? Because the consumer generically represents between 60 to 70% of GDP. So if we have a high unemployment rate, we would expect consumption to take a major hit, as we've seen, and that could well be slow to recover if unemployment rates remain elevated. And that means slower global growth going forward, a more gradual path to recovery, rather than this V-shaped thing that people have talked about and alluded to in recent months. So the shape and the pace of recovery remains very uncertain. We've heard about the V, we've heard about the W, we've heard about an L-shaped worst case scenario where we decline and just flatline from here on in. It is FAB's base case scenario that we will trend towards a shallow U-shaped recovery. I believe that that is the most sustainable path for recovery and the most healthy path for recovery going forward, rather than chasing a rapid V-shaped recovery that in actual fact would require us to relax many of the restrictions that have been put in place to limit the spread and the infection rates of COVID and lead to a second downturn, which could in fact certainly lead to that first reverse in terms of creating a W shape. A shallow U-shaped recovery, much more acceptable, much more sustainable, and perhaps in this context, I would suggest much more feasible. So how has investor sentiment evolved since the beginning of the year? Well, clearly there's been, a seismic change, as I suggested. As we came into 2020, there were some very basic assumptions that most economists, myself included, were making in terms of what would pan out during the course of this year. We had the global economy trending at around a positive growth rate of 3%. That was expected to continue during the course of 2020. US-China trade tensions were expected to ease further. If you recall, there have been some major breakthroughs and an easing of those tensions late 2019, and that was proving to be a flip for global GDP. The US economy was expected to prove resilient, buoyed by the aforementioned robust labour market. I talked about that previously at 3.4%, where it was at the end of last year. And the Eurozone, similarly, was expected to make an economic recovery and further modest gains in that recovery during the course of this year. And central banks were expected to leave monetary policy loose and perhaps ease fiscal policy to a certain extent. Where we are now, 9 months later, in actual fact, only the latter of those conditions has actually proved correct, and that is that monetary policy has remained loose and in fact only got looser over the course of recent months. And we see why. We've seen the impact that COVID had on GDP around the world. Here we look at the major Chinese, US, Eurozone, and UK quarterly GDP numbers. We've seen a rebound in China, obviously portraying a sort of a strong post-COVID recovery story there. But in reaction to that downturn in global growth, we saw interest rates being slashed and fiscal policy sluice gates being opened wide. So we now need a more discerning approach to risk. Yes, the Fed's backstop and central banks generally backstop bid has led to a significant rally in risk assets. We showed the S&P index earlier on. Here we can look at investment grade and high yield and emerging market bonds, all of which have, with some volatility, performed fairly strongly during the course of 2020, certainly post the dramatic sell-off that we saw at the end of Q1 rather, in March and early part of Q2. So we believe now that there is very much a regional bias to be had in terms of asset allocation as investors try to position themselves for the recovery, that shallow U-shaped recovery. The US offers perhaps part of the greatest risk at the moment relative to Asia. We'll talk about the Chinese recovery in a minute. But the election, the forthcoming election in early November between Biden and Trump, the margin between Biden and Trump is now narrowing. The lead, I should say, that Biden had over Trump is now, or does appear to be narrowing, and therefore market volatility, I would suggest, around the US election time will begin to spike quite significantly as well as we get into the final counts and the very uncertain picture that perhaps creates with whoever leads the country post that election. If Trump gets in, we would argue that he may be more aggressive than he's been during his first term in office. And if Biden comes in, he clearly has a very different approach to global monetary policy, global policy generally, than that of Trump. So we would expect volatility to be on the increase. It is my base case scenario that in the UK there will be a no trade deal Brexit outcome to the end of the transition period on December the 31st. Cable has proved very volatile, but remarkably underlying robust in the face of this growing risk of a no trade deal scenario emerging. I believe that cable will come under significant pressure from the high 120s and 130 territory that it's traded in over the last week. Our target for most of this year has been 115. We hit 115 on cable earlier this year at the time of coronavirus and the initial sort of impact. We believe that through a hard Brexit at the end of this year, cable could trend back down through 120 and test that 115 level once again. Meanwhile, from an asset allocation perspective, you could argue that Asia is looking most appealing at the moment, and there we've seen some strong recovery stories coming through in terms of recent PMI data, recent industrial growth, retail sales, etc., as per the latest data as reported on Bloomberg, for instance. So are we past the worst of the crisis? Well, maybe, let's hope so, but in terms of the overarching level of caution that we still need to maintain in the market, I think the figures speak for themselves. With over 28 million worldwide confirmed cases for COVID, and a minimum or a declining number of deaths thanks to technology and the medical advances that have been made towards a vaccine, etc. We are still very much in elevated territory. From a macroeconomic perspective, we are trying to curb and limit the further spread of the infections. And as we've seen here in the UAE, even with schools trying to go back and then having to reclose because of the number of cases that are emerging, as social distancing is relaxed partly, and we open up the economies, not only here, but in the US and in Europe as well, the risk is that we get a second phase of a second surge in infections. And that for me is particularly concerning, given where interest rates are, given that all the ammunition from central banks and governments has largely been deployed at this stage. So if we did get a second spike, there's limited prospect of what central banks can actually do to try and address the underlying issues, other than extending accommodation, fiscal accommodation, the furlough scheme in the UK, basically just ramping up that balance sheet for future generations to have to pay down, which of course is somewhat concerning. So whatever it takes is what the central banks at the moment are committed to doing. Mr. Powell, Mrs. Lagarde, and Mr. Bailey in the UK have said exactly that. So we're seeing policy rates being held very, very tight towards that zero bound, if not at the zero bound, and with probably some more downside to come in some of the major in some of these major interest rate markets. We do believe that we'll be at a zero bound, 0% interest rate policy for the foreseeable future, and certainly well beyond the initial stages of recovery in 2021, as we believe that central banks, as Mr. Powell as well has already suggested, are becoming more tolerant of possible inflation picking up rather than trying to address that in the short term. It's really much better to assume or to assure the recovery is in place before any tightening bias is put in. It will, though, for, while a V-shaped recovery, as I suggested, sounds attractive, the U-shape much more sustainable. And in actual fact, if we look at the path of sort of the S&P 500 estimated earnings as per Bloomberg data, then you can see that while the fourth quarter of 2020 is expected to head lower again after a small recovery in the third quarter, it's going to be a gradual path to recovery through the first half of 2021. And clearly, it'll take us some time to get through the nadir that we've seen in Q2, Q3, or Q2 certainly of this year in terms of earnings growth and what that means for corporate credit quality. Risk of a W, if social distancing rules are flouted, as I've suggested earlier, we need to maintain a level of discretion. We need to remain sensible and cautiously optimistic, maintaining social distancing, wearing the mask, etc., washing hands, and trying to avoid that second spike in infections because of the lack of ability of central banks and governments to react meaningfully to any such event. So our preferred target would be that shallow U-shaped recovery. So that leaves me with the question, how should investors be positioning for the future? And I'd like to make some key macro observations using recent data from my team here at FAB. In terms of sovereign returns, you can see that through different periods of the year, we've had some dramatic and seismic shifts. 2nd of January to the 8th of March, we had positive returns. The GCC plus 4.3% total return, and obviously that reversed quite significantly in the second phase between the 8th of March and the 19th of March, with the GCC and others led by Africa down 27.1%. But as central banks then stepped forward, slashed rates, opened up those fiscal sluice gates, we've seen a dramatic reversal in fortunes. And from the 19th of March to the 30th of June, sovereign returns bounced back into positive territory, buoyed by that loose monetary policy. The first half of 2020, paints sort of a very idiosyncratic picture. And I think that is probably the word going forward. We need to be much more fundamentally driven in our approach to risk, much more idiosyncratic as we look at where to put money and the opportunities for issuers and borrowers, borrowers and investors alike. So sovereign returns through the first half of the year, again, underscoring, and I'll go on to give further details on our preferred regional bias for the GCC here, a solid 5.0% return in the first half of 2020 for the GCC versus 4.5% loss in LATAM and a negative return of 4.8% in Africa. And the GCC EM aggregate returns show a very similar picture of positive returns in that early stage of January through early March, a negative phase 8th of March to the 19th, and then a rebound. And with GCC EM aggregate returns all being in positive space for the first half of this year in aggregate. I love this chart, and I hope you will agree. A picture spells 1,000 words. And here we'd like to sort of just highlight what we believe is the robust fundamental strength and incremental yield appeal of the GCC credit market. Here, the bubble sizes indicate the average credit rating of each index. So the larger the bubble, the stronger the credit rating. And here you see that GCC, with its single A generic rating, 2.89%, 229 basis points OAS at 11.4 years duration, sits out as very attractive relative to the rest of the single A, A minus, A plus bracket for EMEA, IG bonds, etc., and the GCC US dollar IG. But more importantly, the GCC dollar IG and high yield index there, that the single A blue stands out very attractively versus its next neighbor of the triple B plus emerging markets LATAM US dollar investment grade index. So for a small give up in yield and basis points, you are clearly getting a much greater level of credit quality within that GCC bubble as portrayed in this chart. We have a high vulnerability as we shift down the quality curve in terms of chasing for yield. If the correction does come and we start to see interest rates starting to stabilize, or more importantly, a tightening bias starting to be coming to investors' consideration, it's to be argued that the riskier end of the credit quality curve will be the part of the curve that underperforms or gets hit disproportionately on the way back through a recovery. And that recovery could come as we get closer to a vaccine or hopes of a vaccine. But I would be very sort of cautious in terms of pricing that into risk assets at this stage. I think until we have a proven and tested and trial-based vaccine that is globally accepted as working with limited consequences or after effects, and at that point, yes, the market will start to take a much more optimistic view. But for the time being, I think the defensive posturing and that steeper yield curve is what we should expect going forward. In that context, this is a great opportunity for borrowers to lock in funding at these sort of levels. We'd argue that, again, from an investor's perspective, if you're holding sort of floating rate liabilities, then at these sort of levels, given that that bare steepening of the curve is likely to happen during the course of 2021, then again, it's a great opportunity for an investor to lock in against that rising interest rate risk, that rising rate LIBOR risk going forward. Within all of this, the GCC, as I stated earlier, is our preferred or one of our more attractive regions of the world for investing in. As infection numbers improve and stabilize, and as oil prices stabilize and we believe recover during the course of 2021, then again, we think the GCC allure of incremental yield and solid fundamentals will shine through against what will still be a volatile US market and potentially a very messy European market as we work through the second quarter of a post-transition period Brexit in the UK and a reversal to WTO terms for trading between Britain and the Eurozone itself. That's it from me. I'll conclude my slides there and we'll move back to Martin if there are any questions. I'd be delighted. I hope you found this interesting. Thank you, ladies and gentlemen, for your time.
Thank you, Simon. That was very, very interesting, and you covered so many angles. I think we can dig a little deeper in. We're also starting to see good questions coming in from the audience that we'll make sure to reflect. One, for example, is about oil prices, and I'll return to that in a little while. But another one focuses really on the pandemic, and I think that's really what has set a lot of what we have around us off. You discussed economic recovery. We discussed the risk of, increasing numbers of infected people around the world. In a situation with a second wave, what do you think is realistic to happen? Can we see more lockdowns of the kind we saw earlier in the year, or will the world deal with it in different ways to safeguard what we have of economy?
That's a great question, Martin. I think it's the uncertainty that we've been living with since coronavirus first emerged that certainly isn't going to disappear in the short term. If we get a second spike, I have some major concerns, as I alluded to in the presentation. My first major concern is that with interest rates at zero, there's very limited scope for central banks and governments to be able to react positively to quash the rise in infection rates. As far as the economic outlook is concerned, then I believe that the hit that we took from the lockdowns in March were so dramatic and painful for many regions that there will be a general reluctance to lock down fully again. And I see that one of the questions that came in was, is a full economic lockdown really economically repeatable? I would suggest it is repeatable if it absolutely has to be, but it's not economically palatable. And I think governments will do everything they can to avoid that in order to try and limit the degree of social unrest, which we've already seen in the US, across parts of Europe at the times of the full lockdown. But at the same time, trying to educate, if you wish, the global population to live with coronavirus until the vaccine is found. And that means by maintaining and respecting social distancing. We've seen many pictures around the world of I won't say the young, but people flouting social distancing rules the day before sort of more draconian measures are introduced. I'm talking about London, of course, God bless them all. But it will be very difficult to go back to a full lockdown and sell that to the populace. But so we need the population to learn to wash hands, social distance, and respect the fact that their future and their independence, their freedom depends on that. Otherwise, that full lockdown will come again, and it will have to come again.
Good, thank you. You mentioned central bank tools as a set of response here. What do you think? And you mentioned the low interest rates, the very that there won't be any increases likely for quite some time. What do you see as the likelihood for negative interest rates, say from the big ones, the Fed, central bank, etc., Bank of England, and what would that mean for business?
Yes, no, absolutely. And I think that is a very pertinent question, Martin. Many clients and investors have been asking that question of late. Mr. Powell, the chairman of the Federal Reserve, has come out and stated his reluctance or resistance, if you wish, to travel down, the negative rate route. The ECB obviously already has the deposit rate at minus 0.5%, so in negative territory. And one could argue that has had limited impact in terms of economic recovery, or indeed creating inflation, which has been the main mandate of the ECB, trying to chase price stability at or around plus 2%. Inflation is something that's lacking globally, of course, not just within the Eurozone. But I do think there will be a reluctance to go into negative rate territory from the Fed, and I think the same will be heard from the Bank of England. Mr. Governor Bailey has suggested that all tools remain on the table as far as he's concerned. But if you listen to the nuances of what he said and the rest of his MPC have said recently, I think, again, there's a sort of a caution in terms of trying to push what they would, and I would argue, would be very much the nuclear button of going negative rates. So I think rates low for longer. The Bank of England may well cut again, but they're from 0.1% down to flat, down to zero. But interestingly, that then takes money markets, so the SONIA yields, into negative territory. So we do get negative yields, we just don't get negative headline base rates for the major central banks. And that, of course, we can see across the US and Europe over the coming months.
Mm-hmm. And from this obviously has an impact in many parts of business and for investors as well. We have, and you showed interesting graphs on that, on how equity markets at least have recovered a lot. We are seeing all-time highs. I think Nasdaq is up 20% per year this year, as if nothing happened. Yep. And there is talk about an everything bubble, coupled with the risks we have ahead of us, and seeing, as you mentioned as well, risk appetite slightly changing. What do you think is a bad outcome in this environment? We could have a long way to fall.
We could, absolutely. And as you say, S&P 500 trading at all-time, or has been trading around all-time highs. And we saw the correction over the course of the last week, as that the tech element of that bubble And that's really what it's been. It's been the Zooms, it's been the StreamYards, it's been the Amazons, it's been the online shopping that have driven that tech element of the S&P 500 and other global sort of bourses higher over the last couple of months. And so we do now have that breakdown between fundamentals and valuations. I believe, therefore, that if we get a second spike, if we get a second downturn in terms of economic prospects, then it will be very difficult, again, against the backdrop of limited flexibility from central banks, for credit markets, for risk asset markets to continue to perform as strongly as they had. So I do believe that there is a correction due in equity markets as we play through the remainder of this year. It'll either come from a deterioration on the macro front, or it will come through a deterioration in terms of a quick reversal and a vaccine sending probably a knee-jerk positive reaction across markets in the short term, but then realizing that interest rates are going to come off that zero floor. And again, we're going to start seeing a re-steepening of the quality curve and a more idiosyncratic approach to risk. At the moment, high yield and investment grade have both been chased aggressively with investors hunt for yield. And I think we'll get a greater degree of differentiation once the normalization of the economic outlook comes, and we've got past the worst of infection numbers, and we start to see the R number, as we've learned to appreciate so much over recent months, as we see that R number sustainably held below 1.
It's interesting. I think we in business and as investors, we want to be positive. And I think markets have shown that this year to a large extent as well. Do you see any likelihood of a proper depression setting off in the near perspective, triggered by what we see around us now?
Well, I think we saw that risk back in March, and the data shows in terms of the GDP decline that we've seen. Central bank's response, government's response to that, basically headed that off at the part before it could become a depression. Recovery since then. I believe that the advances medically as well as socially and economically now being made probably sort of cushion us against a return to that risk of depression over the next couple of quarters. But again, we're very dependent on continued breakthroughs and advances medically towards the vaccine, and central banks keeping their foot on the pedal around interest rates zero and looking for sort of non-monetary policy solutions to creating stimulus. Fiscal policy, of course, can be renewed, but that's that is going to change the dynamics of many central bank and sovereign balance sheets. If we take the UAE, for example, we're looking at having transitioned from what was going to be positive growth of 3-4% this year to probably, we believe, a minus 3% recession for the UAE. That is also going to impact the deficit position of the government here. The government had approved and was targeting a balanced budget for 2020. That is now, because of the needed investment and support structure, which thankfully has been so forthcoming and supportive for the economy, that's going to be looking now at a return to budget deficit of perhaps 7.5% to 8% for 2020, before sort of gradually seeing some improvement again in 2021.
I think it's interesting, especially what you say about our region, and obviously a lot of the firms we interact with from ADGM side are either based here, of course, or looking to come into this market. I think we've seen from our point of view across quite a number of sectors, companies have had falling revenues. Of course, there's been liquidity issues, there's been layoffs, there's been a rise in insolvency, although it perhaps not that much of a full data on that yet. What do you see from FAB's point of view on the local economy? Which challenges do you see as most important now? Which sectors are you hopeful for? How do you see the next year?
No, absolutely, great question. Clearly the critical sector for the region is oil, certainly within Abu Dhabi Emirate. That we see as continuing to trend sideways to slightly higher over the course of the coming year. We believe that we've seen the lows in terms of the negative pricing on oil futures, and we think that oil will continue to edge higher modestly in 2021. As far as the non-petrochemical sectors are concerned, we were very clearly living through the hit to the hospitality, transportation, retail sector earlier this year. That is starting to come back. Dubai obviously has opened up quite dramatically and quite quickly, and perhaps worryingly so to some, as we look at sort of tourists coming in and potential sort of infection rate risk. But that is a necessary balance that governments need to make, is trying to open up the economy to create and guarantee future economic growth, while at the same time limiting and capping the infection rate. So here, generally, we think that we are going to see a rebound into positive growth in 2021. The delay for Expo 2020, for example, disappointing perhaps at the time, but understandable and highly positive in terms of the long-term implications. That will create positive growth during the course of 2020, early stages of 2021, before the Expo in Q3. That, if it were to be combined and come at the same time as we start seeing more viable vaccine opportunities coming through, puts us into a position of perhaps, fairly robust strength, or rebound, should I say, in 2021. But I think we just need to take that with a little bit of caution and wait for the data to prove itself before we start assuming that we are very much. And again, I would reiterate, I don't want to see a V-shaped recovery or chasing a V-shape. I think that shallow U will be much more sustainable and much more economically viable.
Thank you. You mentioned oil, and we've had audience questions on that as well. And I think you addressed your view on the near-term movements on the oil price. BP issued a report here just the other day looking at demand over the next 30 years. And they expect, I think their normal case is a drop over 50% of global demand. I think they look at one scenario where that drop in demand can be as much as 80% if we want to keep global warming below 1.5%, I think. Yeah. What is your view on that, and what if one of those scenarios played out, might that mean here for us in the region?
Well, I think the key part in terms of that BP statement was the longevity of their view, 50 years. So I don't think it's anything that's necessarily going to impact the region here, UAE, GCC more broadly, and across the oil producers in the short term, as in the next 3 to 5 years. But yes, green energy and the move away from fossil fuels is clearly a trend that is going to continue and will only gain momentum. In the short term, I would argue that there are so many challenges and impediments to broadening the use of e-power, electric vehicles, etc. While they are gaining ground, obviously rapidly, the overall amount of use is still relatively limited. So I think from a demand supply perspective, demand will still maintain a reasonable level over the course of the next 5-10 years. But 30-50 years time, then yes, one should assume that we will have looked to a much greener and e-based global economy. At which point will be electric, renewable energy will be the main source rather than fossil fuels as we see today. So the longer term trend to work towards rather than a sort of a near-term risk, I would suggest, for this region. And for that reason, we believe that while oil prices have sort of continued to fluctuate recently through OPEC sort of price and production negotiations and tweaks, that we will see a gradual rise in the oil price, modest rise.
Mm-hmm. Good, thank you. I'll see we have more activity among our participants here over LinkedIn. One question comes from Ali. How do you see the impact of emerging markets such as India struggling with negative GDP growth on the larger global markets?
That is clearly going to be a negative to consider. And again, one of the reasons why I think the V-shaped recovery is unrealistic, and we're going to be looking at sort of a U-shaped recovery going forward. India previously held as sort of the new engine of growth outside of China, will clearly be struggling with negative GDP growth as infection rates remain high in that region. But at the same time, I think it's all part of sort of the softer global growth outlook. And in terms of the supply shock that many people have alluded to, if factories, be it in India, wherever they may be, having to close because a member or several members of staff have taken ill, and that creates a supply disruption. Well, that's basically what we saw back in February when we had the the proposed supply disruption through Apple, etc., out of China when coronavirus first started to emerge. And again, these are trends that again are going to be key to restricting the overall level of rebound that we see in global growth, but without, as Ali puts it, without sustainable strength and recovery being seen in many of the emerging markets, the more industrial emerging market regions, then again that will be limiting what that feeds through to on a global stage as well.
Good, thank you. And all of those of you who listen, please keep sending us questions. Another one from LinkedIn, and I'm not sure who posted that, is what is your prospect on the UK economy post-Brexit?
Now, if anybody knows me, they'll know that this is my favorite topic of all, probably. Brexit has been one of my love-hate relationships since 2016, and I've been particularly bearish ever since. So the prospects for the UK economy, I think in the short term, there will be a large hit to sentiment in Q1, or more importantly, through early December, through until Q1, as the realization sets in that there isn't a trade deal to be done with the EU. If there is, and I'm wrong, then we'll see a rebound in sentiment, and the equities will trade higher, and obviously we'll avoid that reversion to WTO terms. But I think if we are right and there is no trade deal, we go to WTO terms, the prospect for the UK economy is probably as bad as it will be for the Eurozone economy, because they each depend on each other in terms of their import-export flows. And I think that the imposition of WTO tariffs and quotas post the lack of a trade deal on 31st of December sends the UK economy into a significant downturn again. And that is where Mr. Bailey will certainly take that extra 10 basis points, one would assume, off the base rate from the Bank of England. Sonia, therefore, money market rates would go into negative territory. And in actual fact, Mr. Bailey might again reiterate the fact that he could go further in terms of easing monetary policy. But I think there'll be a natural floor at zero. But net, I think the Brexit scenario is a lose-lose situation at this stage. Lose-lose for both the UK and for the Eurozone if they fail to come up with a trade deal, which seems increasingly unlikely.
Good, thank you. Here is another question from LinkedIn from Kasim Kayum. How do you see real estate market recovery in the GCC and especially in the UAE? Also, which segment do you see recovering the fastest, residential, commercial, or retail?
That's a great question from Kasim. The retail market, the retail estate market has remained under pressure throughout this year and much of 2019 as well. The coronavirus has only added to that weakness, and I think that will continue in the near term. I think from the lows that we've seen, then commercial real estate will probably, if you pick and choose between it, commercial real estate should perhaps see a larger recovery than the residential real estate. We hear, although I don't see much evidence or firm evidence of populations or people leaving the GCC region as such, but that will obviously have a negative impact on residential real estate. Commercial real estate will come back as businesses start to kick back into action, and the recovery starts to feed through. Of course, we're now in an environment where you, I, and everybody is learning to work from home much more comfortably. Hopefully, most of us believe that BAU is still possible working from home. So there may be a reluctance or a reduced need, if you wish, for us all to move back into 100% occupancy of our office spaces going forward. And that, again, will be a natural dampener for demand on commercial real estate, which, again, will limit the recovery of commercial real estate prices. So I think generally the sector will remain under pressure. Commercial real estate will see a recovery as the economy recovers. Residential real estate will perhaps lag that. And as far as retail is concerned, then again, that will lag until we see sort of a more significant return to tourists coming certainly into the Abu Dhabi Emirates. The local economy, the local population can only spend so much. We need tourism to come in and drive consumption higher. And that will, again, lead to a rebound, I believe, in sentiment across retail real estate.
Thank you very much for that. I hope, Kasim, you are happy with that answer. Related to some of the themes of risk you just touched upon, there's a question from Abdallah here. With COVID and everything else happening, the impact of extreme levels of unemployment is likely to be severe. Your thoughts?
Well, we've already seen, Abdullah is absolutely spot on. We've already seen a spike in unemployment rates. We've seen the US unemployment rate go from 3.5%, that historic low that we were at in December last year, up to 14% or thereabouts in Q2. That's improved a little bit, but it's still at 6%, inflated or much more elevated than it was at the end of last year. In the UK, we've seen unemployment rise, but only to a certain extent because of the furlough scheme that the Chancellor of the Exchequer in the UK has put in place, whereby the government's paying 80% of wages for those guys who have been sort of furloughed and put onto sent home while still being paid. That furlough scheme ends at the end of October. And so there's a big question mark about how many of those guys currently sitting at home being paid by the government will move back into their office and be paid by their employer. I would argue that a large percentage of those, given the state of the UK economy and the impending risk of that no-deal Brexit, are unlikely to get taken back into the office, and more likely, unfortunately, will be told that their services are no longer required. So we're going to see a spike in unemployment when the furlough scheme ends in the UK. And anybody that's not prepared for that really needs to just look at the data, because I don't want that to be a major surprise. It shouldn't be a major surprise when it comes through. So generally, I think with COVID and everything else happening, unemployment is going to remain at an elevated level. We are not going to go back to the lows that we saw at the beginning of this year, given that the recovery is going to be slow, given that if it's a V-shaped recovery, then perhaps unemployment comes down quicker than I'm anticipating. But if it is this U-shaped, shallow U-shaped recovery, then yes, employment will pick up as we go forward, but not to the extent that everybody, I'm afraid, gets back to the jobs that they had previously, because certain sectors will be much slower to come back. Hospitality, retail, etc. Not just here in the GCC in the UAE, but more globally. And I know from speaking to family and friends back in the UK, the trends now are very much it's online retail. Everything's done through sort of that very famous online portal for shopping. Other portals are available. But the high street itself is in demise. Shops are being boarded up. People are not. The footfall is not there to justify the overhead costs of running a shop when people, one, are scared about going out in public and becoming infected, and two, they can probably get a better deal or reduced lower prices online. So again, that again is not going to help employment levels, certainly within the retail sector for the foreseeable future.
Thank you. Very, very interesting. Here's a question. What is your take on the Asia-Pacific region and its economic situation?
Okay, well, my focus here at FAB, of course, is predominantly GCC, and I say global as well, but I'd probably take China as my base case sort of example of Asia-Pacific. And, I've been very encouraged to see the rebound that we've seen in the recent Chinese data. There was a slide earlier in my presentation looking at PMIs, and we've seen industrial production, retail sales data recently as well, showing that there is life after COVID. But again, numbers back in Wuhan, going up again, etc. There is still that overarching level of caution and fragility, if you wish, that needs to be priced into the market, because we haven't yet eradicated coronavirus and the pandemic itself in that region. So I think Asia Pacific will probably leading the recovery, led by China. If you go further afield, down into Australia, clearly there are much more severe draconian lockdown rules being imposed down there in terms of border closures, etc. That will limit GDP and economic activity in aggregate in that region. So it's going to be sort of stops and starts, I think, across the region. But for the time being, the positive data that we're seeing out of China suggests there is reason to be optimistic, but we've got to be cautiously optimistic as we come out of this. But we will come out of this.
Mm-hmm. Very interesting. Please, audience, more questions. We have some 10 minutes more, and I think we have an excellent chance of learning from Simon here. So please post more questions. I have one. my role here at ADGM, I have the benefit of meeting a lot of entrepreneurs, young, driven, talented people who are applying themselves to challenges perhaps or future development of various aspects of the business world and the economy around us. If you had a chance to give advice to a young entrepreneur who could place his bet on one industry or a group of industries and try really to build a future there, what would that industry be from your point of view?
I don't think I would necessarily recommend one industry, but I think a diversified portfolio at this sort of stage. I mean, as we've said, with interest rates at zero, this is a prime opportunity for raising funding, for cheap funding. And we've seen, obviously, in the corporate bond market, a plethora of new issuance in recent weeks and months. We here in the region, as well as globally, issuers locking in cheap funding, and from an entrepreneurial perspective as well. That leads to the ability to, if the banks will loan you the seed capital or whatever you might need to get.
That's another discussion.
I think it's a prime time to be looking at that. But I think it's being diversified. It's looking at technology. Technology is something I think we've learned to live with. We've learned to love over the last couple of months. There are sort of online portals which in my sort of old age I'd never even heard of previously, and I'm now using on a daily basis. Fantastic. So the technology side, I think, holds huge amounts of potential going forward in terms of our further development. I think renewable energy, going forward, you alluded to, but I think not a near-term threat to the local economy, but certainly something that in 30, 50 years' time is going to be the standard way of producing energy for the world we live in. I think the green shoots and the getting the lower stages of the renewable energy sector today, again, looks very interesting. Financial service. Yeah. I think it's a broad array of sectors which will hopefully perform. And you could say that from the bashing that the retail sector has had, that stands to look to improve. But again, I think it'll be a focus more on online rather than bricks and mortar as that sector is concerned.
Good, thank you. Nesreen Khodor asks over LinkedIn here, how do you see the recent shift to e-commerce impacting employment here in the GCC?
Yeah, no, again, a great question. Thank you, Nesreen. And I think, we've discussed, yes, the tech boom, or the tech bubble that's been driving, the S&P 500 and others. And again, it's been largely e-commerce. It's been the Amazons, others are available. Driving things forward, and the NASDAQ as well. Employment here in the GCC, I think, given that the domestic population probably uses online e-commerce, probably more than they did, but the bricks and mortar retail sector here will still generate decent activity, will still be seeing decent levels of employment and economic performance once we manage to get tourists back into the region. Obviously, in Dubai, we have tourists as well who go out and want to and spend money. They're not coming to Dubai to invest over the internet to buy things to take home. They want to go into the malls. They want to spend money, and I think that's important transition that we need to make. Having seen it open up in Dubai, once we've managed to feel comfortable with infection levels are limited and declining here in Abu Dhabi, that they are able to open up to get that tourist dollar, euro, pound into the economy as well, which will sort of cushion the non-e-commerce side of the business.
Thank you very much. I believe that we have covered the questions that have come in from the audience so far. We have a few minutes left, so I want to give you, Simon, the chance, if there are any leaving remarks or thoughts, ideas you want to give us all listening now.
Thank you, Martin. Well, first and foremost, I'd just like to say thank you to ADGM for arranging this webcast, and I hope it's been a pleasure to deliver it. I hope it's been interesting, and I thank everybody for tuning in and listening and for all their questions. We are in uncharted territory, as we all know. We are in uncharted territory that comes with the added layer of complexity of uncertainty. If somebody said to us today that this will all be over on the 1st of January or even the end of March next year, it would be something to work towards. For the time being, we don't have that level of clarity or certainty to work with. Excuse me. But I think, given the interest rate environment that we've got in, the reaction by central banks and governments, we will get through this. We're starting to see the green shoots of recovery coming through in Asia, in China. We are seeing the risk of a second wave in Europe and the US. And that, of course, is all commingled with the prospect of a an aggressive, or should I say, US election process, or increasingly aggressive US election process in November, and the no deal Brexit scenario in late December. And in that context, I think we need to look at the market much more idiosyncratically. I believe focusing on fundamentals rather than just pure yield, rather than just chasing risk higher as we've seen with the S&P, focusing more on the underlying credit that you're actually buying into. I think that's where the GCC credit market shines. In terms of that bubble scatter chart that we showed, the relative value of the single A-rated GCC IG space relative to other IGs and EM. And again, that's the approach that we need to be taking. Be optimistic that we're coming out of this. We will come out of this. We need a vaccine. We need a vaccine, but we need a proven vaccine in the foreseeable future. But there is light at the end of the tunnel. Let's just hope that light is not the second wave coming towards us, which I don't believe it is. And I believe that 2021 will be a stronger year, much stronger year than we've had in 2020. But let's just focus on a shallow U-shaped recovery, which I believe will be more sustainable in the long term than trying to put everything on red or black and go for the V-shaped recovery, which actually could lead us to relaxing those restrictions too far too soon, will only then feed into the second down leg of a W or whatever that shape might then turn to be. But the second leg down will likely be more aggressive and more painful than it was the first time because of the limited ability of central banks and governments to react to the extent that they did in February, March, April. On which point I'll conclude. Thank you very much, Martin.
Thank you very much, Simon. This has been extremely interesting. You've given so much food for thought and helped us make sense of the situation from very large number of angles. So I think, and I'm sure that many with me really found this relevant. One last question for you is for all of those of us who'd like to follow your analysis and your ability to make sense of this, how can we do that?
Well, all our research is publicly available on the FAB Market Insights and Strategy webpage, which I would commend to everybody. So please look at that. I can send you the link, Martin, and if people have...
we will post it.
I will ask you to forward that. And of course, I'm on Bloomberg, I'm on email, and always very approachable and delighted to hear from people in the context of economics. But yes, please look at our webpage, and myself and all my colleagues, our contributions, our research is all there, publicly available for everyone to use as they would.
Great, Simon. Again, huge thank to you and FAB for helping us, sharing your views and wisdom on these important topics. Thank you also to our audience for being active, as usual, for posing questions, for listening. And I want to welcome you back. We will continue the webcast series here over the coming weeks and months. Next up, I believe, is 2 weeks from today. We have a webcast talking about family businesses, family offices, foundations, ways for another or one important sector of our economy to work for good succession, good governance, and good models for doing business in these challenging times. Until that time, have a good couple of weeks, everyone. Thank you again.
Thank you.